To weigh in on the broader tech sell-off is Dan Flax. He's senior research analyst at Neuberger Berman. Also, Sarah Kunst, who is managing director at Cleo Capital. And Dan, let me start with you, because I think you're of the opinion that when you see this sell-off in technology names overseas, that this is a real opportunity in some of these tech stocks.
Good morning, Becky. I do see opportunity, and clearly the geopolitical tension, COVID, the recession, inflation, higher rates, to name just a few of the challenges are going to be with us. But when we step back and look at the innovation and the growth outlook in the technology sector, we see a lot to like. So for example, here in the United States, you have Alphabet, where core search is healthy. They're doing a nice job with YouTube and their cloud platform. Amazon is investing aggressively in e-commerce, and their Amazon Web Services remains healthy. So platforms like that should come out healthier and stronger on the other side of it. And then if we think about what does need to happen, this build out of the digital infrastructure, this transformation of the enterprise, you have companies like Cisco, like Microsoft, who have very important roles to play. So even in the face, we do see opportunity in the face of challenges.
But you did not mention any of those Chinese tech stock names. That's an area that you would not touch right now?
We do see longer term opportunity in Alibaba, where they're continuing to invest. Regulation is a factor and is weighing on multiples. We do see, though, opportunity in both Alibaba and Tencent. Tencent, we think, has a variety of key growth assets, including gaming, payments, social, cloud. And so looking out, we do see opportunity in both of those names. I think what's key looking through what is obviously a very challenging period is that these companies innovate, invest, remain valuable to their users, the advertisers, the enterprises. We are seeing them do that. And so I do think those two names in particular are attractive as we come out of this.
Sarah, I think you have a few more concerns about what's happening just because of the interconnected world that we live in at this point, right?
I mean, absolutely right. You look at what's going on right now in China. I'm calling it, kind of the Shenzhen squeeze, where, Foxconn shut down for a week, right? That's not great for Apple. You look over at Russia and the absolute debacle, with nickel pricing, and that's not good for people who need batteries like Apple, like Tesla. The world is so interconnected right now that when there is an extra case of COVID in China, that's hitting stock prices of tech companies in China and beyond all over the world.
Is there a point, though, Sarah, that you say, OK, enough pain has been inflicted, prices have come down substantially, and this starts to look like a bargain?
I mean, if you have the appetite for risk, the Chinese tech market right now is a really interesting place to look. They are getting squeezed on every side imaginable. There's regulatory pressure in the delisting in the U.S. There's regulatory pressure at home in China. There is so much value evaporating from those market caps right now. And so if you think that you are catching, not a falling knife, right, but a rising dragon, go for it. But it is dangerous times out there.
So what would you tell people? What would you suggest to investors to do instead?
I think look at things that are not so impacted by higher interest rates, particularly in the U.S., right? We know that higher interest rates for growth stocks and tech stocks are just dangerous because their valuations are so much more tied to future cash flows. So, I think that this is a time to look at the more boring stuff potentially that isn't necessarily, the cutting edge tech growth stocks.
What are you talking about, like utilities or something? Are you talking about serious defensive names?
I think with the rate hikes, that with what we're seeing in the U.S. market around the interest rates, there's a lot more interest right now in bonds a little bit. Finally, after a very long time, you're not going to get a ton of yield, but you can certainly, look and get something happening there. Even things like my favorite crypto, you're seeing that there's been a little bit more steadiness in that market, and it is likely to be a lot less correlated to what happens, with interest rates and what's happening in the larger markets. I just think some of these tech names that we've been loving for the past couple of years are a dangerous territory right now.